Hello, welcome to Dissident Canada. My name is Tyler. Before I begin, you may hear, if you've got volume cranked up, some munching and crunching noises. That is my dog, Bella. She is 15. She was given like a rawhide snack. As I said, she's 15. She's at the point in life where she gives zero F's anymore. I could attempt to remove the distraction and the noise, but then I would be risking fingers and a trip to the hospital where I might die waiting for my finger to be sewn back up. Therefore, please put up with this because I'm not risking my finger or a trip to a Canadian hospital if I don't have to. Anyways, the topic today is something that came up in the news late last week, which was China saying they had. When China says, oh, we've done this, it means we're in the process of maybe doing this. Just simple translation for that. Of setting up a commodity based payment system. And people were like, yes, it's the revive of the gold standard. China's going to bring back the gold standard. Everything's going to be fiat is dead, gold is back. All glory to the BRICS. You know, that narrative that's been basically going on for, what are we at, like 10, 11 years now, that never materialized because lots of reasons. You know, I've gone through the mechanics of why the people hoping for the gold standard would actually destroy their own country and their own personal wealth in the process of doing so. You can go check up that video. I believe it's something along the lines of the gold standard died with a reason, something like that. If you just want to know, like, it goes into as much of the mechanics of global finance as is tolerable without, really, having to get the nerd shit out and like give a dissertation speech on global finance and how it works. But this is just, BRICS isn't going to save the gold standard. There's no way it's coming back. One, whether or not you subscribe to a theory called Grisham's law, it is there and it has been proven to be real to a certain extent. And basically, the rundown is bad money will always push out good money. So bad money wins in the end, so fiat wins, is basically the thesis. And as you can see, it is very true. But like everything with the BRICS currency plans, they get it wrong. They look at it through the framework of we are the government, we are the central authority, therefore what we say goes and everybody else will follow. And that's quite simply not freaking true. As you can see, specifically in China, with, I think it's since 2017, every, say, year to 18 months or so, China comes out and says, yep, we're banning crypto. We've banned crypto. Every year. You can go back and just look at all the headlines of like, China's banned crypto. Crypto's gone. It's just going to be destroyed. And yet crypto is still massive in China. Like, what the government says does not matter whatsoever, really, when it comes to finance. What at best they're doing is they're creating a payment system for the central banks and the government themselves, not for banks. And I'm going to get into why, but so the idea behind BRICS is you're creating another polar part of the world that is very much political in nature. There's some economic. It's not much. It doesn't really matter to the general whatever. Because like you're thinking like global finance. All right. With what we can just peer into the black heart of shadow banking system, which is the shadow banks. Real quick, real easy to explain. They are banks that do not have depositors. So you can't go to the bank and deposit money. That's not what they do. They're they take investments and make money out of it. It when you look at the regulations, it falls under bank-like entity, not bank. Anyways, shadow banking system. At any given point, there's at least an unaccounted $100 trillion, and that's not just USD. That's everything else, but it's primarily USD. Like you can just say the vast majority of money or currency flowing through the global finance is dollars, and you are correct. Like if you were to take a look at everything, you'd probably get damn near close to 100%. Everything else is just a footnote, to be fair. Um, anyways, BRICS is always been top down commanded, all right? Where you have the entire plan behind it is we, the governments of these mostly currency poor countries, resource rich, we're going to come up with something to deal with the increasing problem of the United States being the global hegemon and having an out of control and mostly insane ruling class, as can be seen regularly. So, yeah, sure, at some point there will probably be flows of, say, maybe diamonds, gold, copper, platinum, whatever, through this system to the Chinese for, services rendered. But it will be done at the central bank or government level. You're not going to see a, like, the pseudo independent banks, like, say, any number of Chinese banks settle in gold or anything. And you won't see, like, a bank from South Africa settling a debt with a Chinese bank in gold. Just, it's not going to happen. And part of the reason is the way private banks work is they are a profit driven industry. And it took them 600, almost 600 years, all right? Very close to 600 years to officially kill the gold standard so that they could have their ledger based monetary system. Okay? That's what they've wanted and have moved towards for hundreds of years. All right? The first instance of ledger based money is, in 1420 something in Venetian banks. All right? Trying to deal with here, let me try and remember. It's the liquidity crisis that comes around with the return of the oh god, how would I the ships the ships that they sent out for trade. When they return, you have to stock up on liquidity, and you have to deal with this, and like you can sap all the liquidity from the system, so what they came out, or when they're leaving, because they have to have money to then purchase goods, or acquire the ships if they're, say, sailing to the Americas, to then acquire things with the use of violence for the most part, to a certain degree. So that's where credit systems really, really start to grow in popularity is in Venice, and it explodes from there. Now you're on a fully credit-based system for the most part. So in a credit-based system, you need money or currency to be fast. You need assets to be fast and as fast as possible and highly, highly liquid. So, and they should give you something in return. So if you look at the number one liquid financial instrument, it is a bond, whether that be a government bond, a corporate bond, doesn't really matter. You are getting something that you can immediately sell. All right. So highly liquid, highly transactable, like money. And if I'm going to borrow a phrase from Manmohan Singh from the IMF, who understands the financial plumbing of the financial system like nobody else, even though I disagree with his assessment that it is a, central bank solvable problem. Doesn't matter. He has a term he uses, the moneyness of something. So with bonds, they are more money than money, because not only are they a promise of money, right? It's a promise of money that is highly liquid, so it's basically just money. You can trade back and forth with bonds. You can acquire credit and consequently debt with it, but you also earn a yield on it, which is, it makes it money plus. So even if you're just, holding on a 10-year note at the moment, Canadian note, I think, is somewhere around 3%, right? Here, let me just give me the Canadian yield curve. 10-year. Yeah, it's like almost 3.2. The last I have, because I'm just checking the yield curve here. Which, this is not a very good yield curve. Anyways, it's like, for the Canadian 10-year, it's almost 3.2 yield. So if you just hold on to it and you're not doing, repo operations, which is, lending it out to other people, and then they sell it back to you, you're getting almost 3.2%. And if you look at, deposits, they're paying under that, so they're just, say, pocketing like a 2% spread. That's how banks work. They're getting paid a lot to do nothing, like 2%, to just hold on to a damn thing and do nothing. Plus, they can then do repo actions. But it's highly liquid. Compare that to gold. Do you get paid for owning gold? No, you have to pay to own gold. You have to insure the gold, which is not cheap. You have to store the gold. You have to secure the gold. It is an expensive process. You net lose money on this. And to make matters worse, from a commercial bank point of view, you have to, it's very static. It doesn't move. Like transferring gold, or even like if you have a gold back note of some variety, right? You're still predicated on the fact of the underlying asset, and the underlying asset is heavy and expensive to freaking move. But then you also have the fact of gold can lie dormant for decades at a time in price action. So the only time when you see gold do its historical thing of retaining purchasing power is when it hits the fan. Like, if you were to, say, make a comparison of what was it? It was the 1980s where gold is just basically flat for a decade. Um, Actually, I think it's even longer. It might be into the 90s as well. I don't have a gold chart pulled up to prove this. That's on me. But um, gold will just basically trade sideways for a very long time until something happens and then it spikes. Meanwhile, you'll have prices go up or down depending, and gold will just stay at the steady state. So you're actually in the short run you have lost purchasing power, which doesn't matter very much for a bank. Purchasing power doesn't matter, but the problem is you are basically losing value of the asset. Um, and if even if you look right now with you could say, oh, but look, gold's going up in price. There's massive amounts of buying pressure. Sure, but the vast majority of that is central banks. And as I routinely say, they really don't freaking matter for the financial system. They can't control it. I used the Bitcoin example earlier, but here's another thing. Rehypothecation is technically not the most legal thing to do in most jurisdictions that banks are regulated in. Do you think they care? They will just shuffle that asset under to a subsidiary of theirs in a different regulatory environment and do it there. You cannot constrain banks. Like, they get away with so much shenanigans on their balance sheet. Look at Silicon Valley Bank. Silicon Valley Bank failed for numerous reasons, but the big one is they were over leveraged in what the government considers safe as safe assets, which was the US 30 year. The problem is the US 30 years market is basically just pensions and the bare minimum requirements of a bank. So when they needed to be liquid, they had an illiquid asset. Which is why, again, gold. The regulatory requirements of being deemed illiquid, if you can't liquidate fast enough to meet the depositor's demands, you are screwed. You can't have gold on your balance sheet as a backup. It's just not possible. And if you don't believe me, go look at like the top 5 largest banks in the world. It's like every quarter, or I think they also do monthly. You can look at what's on their balance sheet. They really have fuck all gold. They have shit tons of treasuries and bonds. Their exposure to gold, while probably, I haven't checked in the last little bit, is probably gone up with the price of gold. It's going to be like ETFs and other paper instruments, probably a lot in derivatives, to be honest, because derivatives are liquid as shit. But again, the problem is, as a commercial bank, you have to be able to make money on something consistently. So again, if you look at like the S&P 500, for the most part, in this euro dollar environment that we currently live in since 2008, even though technically before, but 2008 radically changed everything. It goes up on a long time scale. If you look at the S&P 500, it looks ridiculous. Its modern day iteration looks ridiculous compared to what it used to do. There used to be like lulls where it would be flat. It is no longer like that. It goes up, there's an issue, it goes down, it recovers, and it goes up. A consequence of the Eurodollar system. But you need assets like that as a bank. You have to be constantly making money. And to be frankly, with gold, you really can't do that. Even with, say, gold miners. Like, you can't, as a bank, be like if you're, say, JP Morgan Chase, right? You can't replace your treasury holdings or your bond holdings of like several $100 billion, if not more, again, given any point in the time of day, with, replace that with gold miners and get paid, anywhere from, say, 3 to 15%, depending on where you are in their profitability scale. Because if you run into an issue where you need cash, all right, you need a couple $100 billion of cash, you can't liquidate that without crashing the price, and you cause issues. Whereas the bond markets are so large, especially the US bond market. Like, you're talking probably by the end of the year, closer to $40 trillion of a total market. Like, you can sell off a couple $100 billion with the amount of buying pressure that is in the US yield curve or in the US bond market this year and have relatively no problems as a bank. Like, again, if you pull up USTreasuryYieldCurve.com, show you the yield curve heavily inverted. Now, this is as of the 15th of September 2025. It will change, but like the 3-year is creeping down. The 3 and the 2-year is creeping down to a full point inversion on Fed funds lower target of 4.25. Like, you're with 3, you're sitting at the 3-year, you're sitting at 3.52. So you're full point under the upper bounds of Fed funds, and like the 2-year is 4 basis points higher than that. So again, like the middle of the curve is a full point inverted on the upper target when it should be in the middle of that upper target. If you look at this as if, the financial system doesn't control rates in reality. Like, the 10-year is almost 25 basis points below Fed funds, the lower range of Fed funds. Okay? Yes, when you look at the 20 and 30-year, you are very much above Fed funds, but only, 15 and 18 points as of, again, recording on the yield curve. Like, it's not that big of a deal, really. Plus, like, again, the 20 and 30-year are as illiquid as shit, and there's not many 30-year bonds given. If you look at the time frame where the 30-year was released, there's not a whole lot of them kicking around. So yeah, like, if you just look at this through a practical reality of the commercial banking system, right? You're not going to have a return to trade in gold or even gold-backed notes, because at some point someone is going to demand a massive amount of redemptions of that gold-backed note, right? And then you're wiped out. Banks don't do that. Like, you can't run into a system where the underlying asset could have a massive call on it, and then you're screwed. Even if you look at, say, it's why why banks and hedge funds will trade in derivatives. It's because they don't have, they get the exposure to something because it's a contract saying, hey, the asset that this represents, that you have no demand call of. So if you have a gold-backed derivative, it's based on the price of gold, but you do not have a note of demand for the underlying asset. So you can't redeem for gold. But what it allows you to do is have a exposure to gold that is extremely liquid, because again, derivatives market is massive. If you are just looking at FX, you're looking at well in excess of $100 trillion in FX derivatives. And that's just what like the IMF and other massive regulatory bodies will recognize. It's much higher than that. Was it the BLS in 23 in September was talking about derivative risk being like a quadrillion or even a quintillion. Like it's the amount of money is ridiculous, especially when you realize like they're trading they're high frequency traders trading on like 0.0001 of something. Like it is so ridiculously small. You need a vast amount of money to just make, a little bit. But anyways, like sure, Russia and China may start trading, like Russia might buy raw materials with gas or be like, "Hey, we have gold bullion here, have it." But it's not going to be private banks. And the private banks are the ones that matter most because they are the system. If you don't believe me, okay, go look at your local, your nation's money supply metrics. Search in Canada if you live in Canada, and go M0 and then burst M2. And you can throw an M1 there if you want. All right? You can expand the definition of government controlled money supply to M1 any day. I'll give it to you. And you will see that M1 is dwarfed by M2. And M2, if you can find the aggregates, which is just, the list of what they count, it's not 100% detailed because these people are evil and will not give you exactly what you want to know because it will blow up their narrative they are producing. But if you look in there what they consider, you will see mostly of what's counted in M2 is debt. And the debt is all bank created for the most part. Once you discount M0, because a lot of M0 or not so much with Canada, but with the United States, M0 includes things such as highly liquid instruments being treasuries. So when you consider that there's like at any given point, the treasuries they're talking about, which is 6 month and lower, is what is it? It's 2 point something to like maybe 4 trillion. And like US money supply, what is M2 today? US M2. Oh, we're only at this is from July of this year. It's at 22, what are we in, trillions? Right, because 22,000 billions would be 22 trillion. Yeah. That again, compare that to M1 and M0, and it's like, yeah, sure. The Fed controls the money supply. Sure, they have everything to do with money creation. Anyways, that is the best way I can explain why, as much as say China and BRICS wants gold to be backed, it's not. Like this isn't even discounting that China would have to have a fully trusted gold back currency, which they're never going to do, by the way. They would have to radically alter the entire way they operate financially. Same with the entirety of BRICS. If they wanted a BRICS back, like if the BRICS nations created a central bank, and that central bank issued a currency, all right? For that currency to matter, they would have to supplant control to the markets, and they will never do that. That is not in their nature. Like, especially Russia. There is no chance in hell the Russians hand over any amount of sovereignty over their money to another nation. The Chinese aren't going to do it either. It's why like you get these leaks of, oh, here's a concept of a BRICS backed currency note. It's like, it's never going to happen because these countries would have to give up their sovereignty to a larger degree than the United States has with its monetary policy that really does lack the money. So, never happening. That's the video for today. Until tomorrow, have a good day. I am thinking of talking more in detail about NATO false flags that have happened, because there's been 2 of them, and I think there will be more, but it's also interesting that they are not picking up speed whatsoever. So that'll probably be on the docket maybe for tomorrow. We'll see. Can't think of anything else at the moment. I mean, Parliament's is supposed to be in session, and they're going to say some dumb shit. It's leaked out of, I think, the Minister of Finance. I just saw like a little headline of it that the deficit, the Canadian deficit, is going to be larger for the fiscal year. Yeah, no shit. I said last year, when Freeland came out at the beginning of this year and said, the federal deficit was 80-some billion dollars. I was like, no, she's probably lying. It's probably 100. I'm still on that assumption that it is still closer to 100 billion of the last year's deficit. And I would presume this year's deficit will be over 100 billion. That they come out and announce and say, oh yeah, it's only 100 point whatever billion over budget. But I would not be surprised if in reality it was 120 to 125 billion more, or that would be 20 to 25 billion more than what they'll probably say. So have a good day. See you tomorrow.